Hey everybody, welcome to another episode of Real Estate Chat with Robert Eid and myself, John Perez. Today we're going to be doing something a bit different than our previous videos. We're going to read through some of the real estate articles that have been released in the past week, and we're going to talk about it and comment on them. So we're going to pick some of these details apart, tell you what's relevant, and also share with you how you should decipher the messages that are being written in these articles. Ready to go, Robert?
Yeah, man.
Awesome. So let's start with the first one here, October 11th. So a bit over, was it a week or so? But anyway, roughly around a week. Rosenberg sees 1990s style Canada housing bust, hurting spending. So two things in this headline, 1990s style housing bust, and then hurting spending. And we're going to find out what they're talking about with each of these two. But just to talk through a couple of these key points, and then Robert and I, we're going to digest it for you guys. Basically, you're saying that the drop is not going to be 10 to 15%. It's going to be more like 30% down. Now they're talking about all throughout Canada. We know based on our previous videos how much of a decline we're in right now within the Toronto market alone. But basically, they're saying that what happened in the late 80s, early 90s, due to then John Crow basically putting in measures to stop or crush the inflation. But this was occurring over a pretty big time period from 1989 to 1996. Now, I wasn't licensed back then, but Robert, you were in the real estate business back then. Why don't you give us a bit of a background in terms of what happened that caused the decline in the late 80s, well, the late 80s to 90s first the climb and then the great decline into that. And what was done, and is it similar to now? And can we see 30% declines?
Okay. One calamity leads into another. And this really starts in the early 70s. There was an oil price shock. And the price of oil shot up, OPEC politics, world, blah, blah, blah. Interest rates went up gradually from like 6 to 10, 12 over the course of 18 months. While interest rates were going up, house prices went up. They doubled, except they doubled from 30 to 60, which sounds like such small potatoes to us now, but it's still a double when that's the world that you're living in. So they raised interest rates and cooled things down, and inflation was high all through the late 70s. And we have a chart there somewhere that shows prices going down when you adjust for inflation, but prices going up marginally when you don't. So then you remember Paul Volcker gets mentioned every now and again. And Paul Volcker was an American Fed chairman who decided he was going to beat inflation by raising interest rates. So people all talk about, oh, I had a mortgage that was 18%. Oh, I had a mortgage. So they tried to kill interest rates and they found it was backfiring. So they dropped them again. And then prices started to take off again. And inflation started to take off again. So they had to do it again. And that's 1989. In 1989, we'd had a boom going in Toronto from 85 through 89 and sort of quit in the spring of 89. And then everything calmed down in the summer. You may know some of the months, just like now. And then it hit a new peak for prices. I can't remember volume in October or something like that of 89. And so then it went into the winter doldrums and everybody was looking for a big spring in 1990. Except guess what? They kept on raising interest rates and it never happened. And the whole trickle that happened from the peak of 89 down to 1995, it took a long time to work all of that stuff out of the system and get down to interest rates around 5 or 6%. And the prices adjusted again over time. And if it was up to me, I'd say that's the scenario that we're approximating now, except that's looking back and seeing the whole thing where you can't see the whole thing now. And the other thing we have to balance that off against is 2008. In 2008, there was a big shock to the world financial system. And everybody thought the world was coming to an end. And prices, because there was no sales in late 2008, prices went down, reported. The ones that were sold at much lower prices. And the houses that were being sold were sold by people who were compelled to sell, and so they sold for less. And then all of a sudden, these miraculous things came from TARP in the United States and bailouts in Canada and dropped interest rates. And by April, May, June, the prices were right back where they were before this fiasco had happened. However, they can't do that again because they were already at dirt cheap rates before. So people are expecting to see a replay of 2008, and they may be disappointed unless there can be some huge interventions again that bring it down. Now, the guy who mentioned that has an agenda, Rosenberg. And the guy who's playing that, Bloomberg, is a shill for, it's the TV station, the shill for the stock and bond business. They want the money that the investors normally plow into real estate to go into the stock and bond business because that's what's for them. So anytime we look at one of these commentators, we're going to say, who's saying it? And are they pro real estate or are they anti real estate? You and me, we're completely flat, even in the middle, of course.
Right. And so let's pull up this graph. This is on your website, www.unclebobexplains.com, which is exactly what you were describing.
Oh, gee whiz, yeah.
Is the run up in terms of the price. Now you have two lines here. One is the price adjusted by CPI. The other one is just the nominal or the average annual price.
Yes.
And this is sort of what we're seeing here is that peak of 1989, then a dip. Interesting, you pointed out that this happened towards the end of the year and then the spring market didn't materialize. But then what we saw from that point on is a huge dip, I mean, relatively speaking to recent times. And the recovery after adjusting for inflation was 21 years. So Robert, when we're looking at this current market that we're in, we're seeing that there's still 2 interest rate increases anticipated for this year and probably for early next year, depending on what's happening with the housing market and inflation in general. Inflation continues to increase, rates may continue to increase. So should we anticipate that something this drastic could happen? And by the way, how many, like we're about 21% down from the peak here in the Toronto, like greater Toronto area. What are we going to see in terms of what could happen from this point on?
Okay, well, put that thing back up again. And when you're in it, you have to look at the nominal. Okay, when you're in it, so go to the lower rate, the lower prices. It doesn't seem so bad in the lower one. And that's what you're in. It's only when you adjust for inflation 20 years later that you see what was really happening with all the factors at play. So in reality, the price went from like 280 to 200. Now that's still a lot, right? 80 on 200 or 80 on 280. That's, you know, I can't figure it out fast enough. It's a third anyway. Yeah, it's probably a third. So it's not impossible. If we are seeing a worldwide crisis, to see values that were pumped up, if we go to the other end of the chart, you'll see that prices had been accelerating perhaps faster than they should. What goes up must come down. If there's a boom, there's going to be a, and what was forcing it up was 0%, 1%, 2% first mortgages.
Cheap money, basically.
Cheap money. So if you've got inflation at 2% and an interest at 2%, it's free money. You might as well buy a leveraged investment. You control the whole thing. It's rising like crazy with 20% down. So it was a spec market. Okay, you see on there more specs. It's a spec market. So the spec, that's what you have to start with again. Maybe I've said it too many times. You got owner occupied and non-owner occupied. Non-owner occupied does not care. It's just, where will I put my money? Owner occupied cares because they're saying, I put every nickel that I have into this house and I can't lose it. So prices don't fall so much on owner occupied because they got to live somewhere. And if this is as good as anything and they're going to underwater and they're going to lose money and have nothing, then they don't sell. They just stay there because it was perfectly good when they bought it. It's perfectly good now. So they just stay there until they wait for a better time. And that's really what we're all talking about and guessing about. The reports that come out, like every time there's a monthly price or the Canadian Real Estate Association or, you know, the CMHC comes out with a prediction. And is 10% a lot? You know, last year when we said prices went up 20%, was that a lot? You know, this word unsustainable.
Right.
That's the only thing. You can't go up forever. The trees don't grow to the sky. So
exactly. And prices have gone up, just like if you missed our last episode, watch the last episode, just the prices went up so quickly and aggressively that when you look at a 30% decline, when you base that on the fact that prices have gone up 44%, according to this article, then you're still ahead, right? In terms of the long run. Now,
as long as you're not the last guy in.
Exactly. I mean, the article talks about Canada-wide and it talks about interest rates. So let's jump from one interest rate related article to another one. This is from Urban Toronto. And
Yep.
this one's talking about interest on interest. Rising rates lead to reduced proposals in Urban Toronto Pro August report. Now, Urban Toronto, they report on developments and whatnot happening in the Greater Toronto area for particularly new condominiums. And it's a great resource, of course, to find out what the new developments are planned for, proposed, and whatnot.
Yep.
But basically, they're talking about new developments for development came in at 9 applications compared to 24, and they're comparing August of this year to last year. And that's obviously a 62% decrease over year. Basically, the article is talking about how the supply would be tightening in terms of new proposals, bringing in new inventory of condominiums and developments into the market as a result of interest and as a result of rising, because of rising interest rates is going to be causing a decrease in the number of new proposals to happen. So when we look at this, Robert, how does this affect? I mean, new developments won't come online for 5, 6, if that, probably now 8, 9, 10 years for new condos because of all the red tape and all of the hindrances that are in the system to
Yep.
the backlog and whatever bottleneck, whatever you want to call it. But how will that affect things, and what should we consider today when we're seeing that there is reduced applications or proposals happening?
Well, 1 month does not a market make. And so if last August was a boom and this August is an unboom, then I would like to see 3 months either side of last August and 3 months either side of this August before I make that comparison. Now, Urban Toronto, normally I like because they give you lots of background information. They follow a project all the way through. There's nothing wrong with what they say. However, too tiny a slice of time. And developers, the way they do condos now is they do not dig until every one of those units is sold. Sometimes only 70%. I think they're mandated by the financing, the principal that give them the financing, the lender, that must have 70% sold before they can dig, before they'll give them an advance so they can dig. And so some of those projects that were announced last August, maybe they'll never go. Maybe it'll be this economic viability clause that'll be pulled and saying, sorry, we have to give you your money back. You thought you had a great deal, but we're not building that thing anymore because there's no sales, there's no momentum, there's no confidence. Interest rates change the whole perspective. We can't borrow at 4, we have to borrow at 8. It doesn't fly anymore because they have to go through a whole interim phase, a whole mezzanine phase that's very expensive. So I'm going to say that that's a factor, that them not coming with more supply doesn't bother me at all, because those condos were built for specs. They're built with tiny units, no parking, no locker, crammed against the subway station, crammed against the highway, crammed against the only people that are going to buy, though, are people that are waiting for the 5 years for it to be developed to flip it just 5 minutes before it's time for occupancy. So it doesn't affect us in the resale market at all. It's a confidence killer, but we already have killed confidence. So
Well, so I'll say maybe one way it does affect, well, the overall big picture is the fact that, so developers are looking at today's market conditions, and their proposals are obviously for projects that are not going to be ready until several years from now.
Yep.
And so one way to look at this is there will be a trickle-down effect affecting supply, which is, everybody knows this, the supply issue will never be fixed unless, obviously certain things are done within the city, within the province, that allows for further development and not so much restrictive use of land. But I mean, again, that's time, that's politics, that's like a whole bunch of stuff that's going to happen in order for that to happen.
Yes.
But what they're looking at is, for example, you and I know that some of the condominium projects here in Toronto are like, some of them have hit $2,000 per square foot, right? And so when we're looking at interest rates that have gone up, affordability, of course, is affected there, but that's in today's time frame. Now, let's say 5, 8, 10 years from now, when these projects are built, could one assume that we're looking at 6%, 5%, 7% mortgage interest rates, sort of what we're seeing today, or sort of where it's going? Or will they be at 4%, 3%, 2%? And will things be okay today? I think part of it is, if you're a real estate investor, if let's call you a speculator, if that's what you are. If you're speculating that prices are feasible in terms of buying pre-construction today, what you'd have to agree on is that if you're buying at 2,000 per square foot today, when your project is completed, for you to profit from that, it would have to be greater than 2,000 per square foot. So if you're buying $1 million 2-bedroom condo today, you'd hope to sell it or flip it or rent it out when the value of it is at 1.3 million, right, Robert? Now, if that's not the case, what does a speculator or what does an investor do? Do they buy into the existing resale inventory as an investment, or do they wait, or do they? Well, I guess what I'm getting at is if the proposals are going to decrease, that means the projects coming online will decrease. Is it reactionary really to the demand side of the marketplace, meaning less investors or speculators coming into the market, or they just want to tighten the supply because they want to keep that price point? And if they're not going to get that price point, why would they propose a project for lower amounts of money when it's going to cost them more?
Well, I'm not the guy to talk about spec condo developments because I hate them. I hate this whole idea of selling assignments and flipping the future. It creates the type of property that we don't need on the real estate market, resales. We don't need tiny units in awkward spots, blah, blah, blah. So that's my bias. So it's not a supply and demand thing. That is a business thing. It's like a commodity. It's intended for someone as an investment. It's not real estate. It's speculation. Okay. So I don't think speculation has any place in residential less than 3 units. And I don't encourage it. And I'm the wrong guy to talk about it. That's what I said at the beginning. So
All right, let's jump to the last article that we're going to review today, which is also from Bloomberg, BNN Bloomberg, which is real estate. CMHC Deputy Chief Economist predicts 15% housing price drop by Q2 2023. Of course, this is on the national basis as well. And again, he sees on an annual base prices can growing 2.6% in 2022. And we talked about this again in our last episodes. For those of you who missed out on those, watch the previous episodes where we talk about economists from the major banks and also from the real estate brokerage brands adjusting their expectations. So this particular one is a 2.6% increase nationally 2022 compared with 21% increase in 2021, 21.3% increase in 2021, and then declining 6.3% in 2022, rising again 2.1%. So I mean, these are all predictions based on whatever modeling, like all sorts of these banks, economists, and real estate brokerages do. But how do we read that? So the typical homeowner there that sees this article and gets afraid about what's going to happen, some of them are probably going to retire and they're like, wow, my nest egg is slowly dwindling away. If they're relying on their home as a line of credit, as a bank, wow, you know what, my line of credit is probably going to shrink. And even if I did borrow money from it, it's going to cost me a lot of money. So what do we do with these news? I mean, do we get scared? Do we sell our place and maybe rent, or do we just sit tight and wait and see what happens? Because in the long run, things will be okay.
well, that you're absolutely right. There's three, since we're throwing away the non-occupied real estate investor as part of the market for the next 3 years. They're not in it. Okay. They're going to sell and take a tax loss. They're not in it. They're not buying nothing. So now you've got the resale customer that's either a last time seller, grandma who's lived there for 37 years, first time buyer, we know what they are, and someone who's going to sell their semi to buy a detached, the buy to sell customer. So they look at that and they say, oh, it looks like there's going to be a slow time next year. Now, the last time seller, he says, oh no, I should have sold last week. Can't do it. So what's he going to do? He's going to either wait longer or say, okay, well, I got to do it when I want to do it, so I'll do it when I feel like it. First time buyer's going to say, well, I'm going to wait then. I'm going to wait until, I definitely know that I've got a very good bargain in this particular property, or until the whole market seems to have turned up, and then I'll jump in after everybody's jumped in. And the buy sell customer is gradually going to realize that this is a great time for them. I said this the last time, that you're always going to be a certain number of dollars away from what you wanted to do. So if you still can do that, and you factor in interest rates and monthly payments, now you have a chance to really focus on that target. And if you can find the target that makes you happy, and you know what, you've got an assessment revised now on what yours is worth, if that differential works, then you can do it. And there's all kinds of things you can do with a trade-in plan, different inventive ways of doing a bridge between one house to another. That is not tricky, is not complicated, and is very possible. But your question was, what is this CMHC guy saying that prices are going to drop Canada-wide, 15% between Q2 of between Q1 of 2022, so the peak of the market here, and Q2, the end of the spring next year. So entirely possible, 15% across Canada, probably double it for Toronto. So we're already at 20. So for it to go a little bit more, I'm not surprised. And it just depends on the starting point that you pick and the bottom point that you pick. Now, the interesting thing that you pick with that one is this guy, Patrick Perrier, who is the Deputy Chief Economist from CMHC. Now, this is a career government employee. Okay. Does he have pension? Does he care what happens? No, he doesn't care. Is he out in the field every day looking at houses? No. He's looking at charts that was prepared for him by a team. And he says, okay, according to the benchmarks that I look like, this is the reasonable probability. He came up with a report that says, have house prices dropped as much as we believe this year, which was a whole algorithm that he developed saying, well, okay, if we compare the HPI, the house price benchmark mixed up combination to and how much that has changed to the average price, how much has changed, maybe only half of it is actually a drop. And there will be a price selection. There will be cheaper houses selling. There will be not expensive houses selling. And so the average price will come down because of that. So anybody who owns a house that sees that will like that, saying, oh, good, it didn't go down, just the lousy ones went down. But this guy has got to come out with something. Right, CMHC is in charge of housing. He's got to come up with something. So if you really look at what he said, he's picked the middle ground. It's not the mush like the guys at Royal LePage said or what the RE/MAX said, because they're in the real estate business. They don't want to say anything bad, but they got to say something a little bit bad because it's been tremendous bad. So they got to say something. And Rosenberg from Bloomberg, who wants your money in his pocket rather than buying a condo, he says it's going to be super terrible. It's going to be like the worst time you can possibly think about. And he's a perma bear. One of these times he's going to be right again. Right. It's taken 30 years for him to be right. Yeah. And so what's CMHC going to do? Right in the middle. So it's everybody has an agenda, and they're just defending their position, their job, or the industry that they represent.
Yeah, and it's anybody's guess. Let's face it. Nobody really knows what's going to happen in terms of the price. You can forecast it based on past financial probability models, whatever fancy things economists want to call it. And at the end of the day, in the real estate trenches, Robert, you've said this a lot, is that, there seems to be such a focus on price. Like almost every single article, even prices when prices were going up, there seemed to be such a focus on, double-digit price growth and whatnot, because ultimately, at the end of the day, we want to know how much we're worth, right? We want to know what our largest asset is worth. And we feel great about it when they've gone up double digits, and we feel kind of bad about it, but we still have to live in it. So when prices are down, it's, hey, we still live in it, and that's okay. Better than renting, some people would say. Other people would say, you know what, you're actually better off renting, depending on what your point of view is. But ultimately, we're looking at some sort of guidance in terms of where the market is going. But Robert, you said this before, is, what's more important than price is being in a place that you actually want to live in and love to live in, right? It's what's the reason for you to make that move? What's the reason for you to buy a place, sell a place, and move somewhere else? And when you look at it in terms of all these distracting headlines and distracting social media and real estate agents, all of our colleagues all posting all of their different things on social media or whatnot, ultimately it comes down to you as a buyer, as a seller, as an investor, as a renter, making a decision as to what you want to do. And if you need a bit of that guidance, we thank you always for spending the time with myself and with Robert. Feel free to ask us questions. If you're watching this on YouTube, comment in the comment section, share it with your friends and the people that you want to help get informed about the real estate market. Anything else, Robert, before we wrap up this episode today?
Very good summary, John.
Good. All right. Thanks for joining us on Real Estate Chat. We'll see you in the next episode. Take care.
Goodbye.